I want to start this video out with a special message for my subscribers. You are an asset to this channel, and I depreciate you a little bit more each month. Remember, I don't charge extra for the accounting humor. Welcome to Accounting How To. I'm your host, Carolyn Grimm, and that is my sidekick, Terrence. Looking buff today, little buddy. Terrence joined a gym. In today's video, we're going to be talking about depreciation. This video serves as an overview of depreciation, and then in other videos in this playlist, we're going to get into how to actually figure depreciation based on 4 different methods. Now in this video, it's accounting depreciation that we're talking about here rather than tax depreciation, which we'll have a separate video for. Now, before we can dig into the topic of depreciation, we have to start with the topic of fixed assets. So what's a fixed asset? You'll also hear it referred to as a long-term asset or as property, plant, and equipment. So these are assets that a business uses to create revenue, like a piece of equipment used in a factory or a factory building or a warehouse building, vehicles, gym equipment, office furniture, computers. So those are assets that we are planning to have for a period of time, 3 years, 5 years, 10 years, 30 years, and we're going to use those assets in order to create revenue for our business. So those assets lose their value over time. Let's take this piece of gym equipment, this bike that Terrence is riding here. You probably can guess that having a bunch of Tyrannosaurus Rexes using your gym equipment is going to wear it out pretty quickly. Nothing personal, Terrence, but you and your friends are a little bit rough on the equipment, okay? So as we use up an asset, it becomes an expense. And with a fixed asset, that expense is depreciation expense. So depreciation is about the allocating of an expense rather than the valuation of an asset. So coming back to the matching principle, what we want to be doing is we want to match the expense, the loss of value over time, to the period where the revenue is being generated. And that's different from what the asset is actually valued at in the marketplace. So we can buy an asset, completely depreciate it on our books so that its value is 0, but that does not mean it doesn't have value in the marketplace. So when we're talking about depreciation, we're only talking about the recognition of an expense. And when we're talking about depreciation, we're talking about estimates. So we're going to estimate the reduction in value. We're going to estimate how long we think this asset's going to last, its class life or its useful life. And we're going to estimate the salvage value, the residual value, what this thing is still going to be worth in 3 years or 5 years or 30 years. So it's all based on estimates. And that's an important point to realize as we get into the other videos where we're actually computing how much depreciation expense we're going to take each month. So we need to understand some terms. We need to understand what the cost is that we are recording our fixed asset at. And generally speaking, it's whatever we paid for the asset plus any costs that we had to incur in order to put that item in service. When is it able to start generating revenue for us? So let's say we buy a piece of equipment, but before we can start using it, we have to pay to have it shipped to us, or we have to pay our employees to go break the machine down, pack it up, and bring it back with them. Or we have to do some kind of modifications to that machinery before we can use it for what we need to use it for. So those are all examples of costs that we're going to include in the cost of that item. And we're not using what the item is worth in the marketplace. We are only looking at what we paid for it. So even if we got a really great deal and it's worth $30,000 more in the marketplace, we are only recording what we paid for that item and any costs incurred in putting it in service. So then when we talk about class life or useful life, the IRS has come up with groups of assets that have a 3-year life, a 5-year life, a 7-year life. So we have that guidance to go by. But we can also make a different estimate. So if we have a machine and we think it's going to last 5 years and the IRS is saying, we think it's going to last 7 years, we can use that 5-year amount because it's based on some sort of realistic estimate on our part. And then when it comes to salvage or residual value, what we're looking at again is an estimate. We are estimating that in 5 years we would be able to sell this asset for $500. Or we're estimating that at the end of its life, it will not have any value at all. Maybe it's some sort of a computer program. Now, the next thing we need to understand about depreciation is a new account called accumulated depreciation. This is a balance sheet account. It is a contra account. It is a contra asset, meaning it works the opposite of what a normal asset would do. So a normal asset would have a normal debit balance. We would increase it on the debit side of a journal entry and decrease it on the credit side of a journal entry. With a contra account, it works the opposite. Let's look at what that looks like once it hits the balance sheet. So here's a little snippet of a balance sheet. We have an asset that we paid $3,000 for. It has a 3-year life, and we're going to divide this expense, this depreciation expense, evenly over 3 years, just for simplicity. So in the first year, we're going to do an adjusting journal entry of depreciation expense, debit of $1,000 and credit of $1,000. In our little balance sheet snippet, now we can see that we have the cost of the asset. That's always on our balance sheet. And then below that, we're going to keep track of that reduction of value. So in the first year, we have a $3,000 asset. We have accumulated depreciation of $1,000 and a net book value, the value of that asset on our balance sheet, of $2,000. In the second year, we do the same adjusting journal entry, but now when we post that to our accounts, our accumulated depreciation is at $2,000. So we have the cost of our asset, $3,000 minus our $2,000 in accumulated depreciation, leaving us with a net book value on our books for that asset of $1,000. The third year, we're going to do our adjusting journal entry again for $1,000. When we post that to the accounts, now our accumulated depreciation is at $3,000. So we have an asset that we paid $3,000 for. We have fully depreciated it at $3,000. So now our net book value is 0. Now, had we had a residual value on this, we would have only depreciated down to that residual value. And again, this doesn't mean that just because it's worth 0 on our books, that it's not worth something in the marketplace. We could turn around and sell this for scrap, or we could trade it in on another vehicle, or sell it to another business. So all we're doing here is tracking the reduction of value so that we are conforming to the matching principle of GAAP. Now let's talk about what happens when we purchase a new asset. Let's say I'm a gym owner and for some inexplicable reason, I need to replace a bunch of exercise bikes. So when we purchase a new asset, we're going to add it to our chart of accounts. And we're either going to add it as its own fixed asset account, like for example, Ford F-350, or we're going to add it to an existing fixed asset account like vehicles or office equipment. So it can either be its own asset or it can be grouped in with other assets that are like each other. So when we do that initial transaction, if we're talking about accounting class, we would be doing a journal entry that would be something like debit to vehicles and credit to cash or credit to notes payable. If we were doing it in real life, IRL, as the kids say, do the kids still say that? Then we might be doing something like writing a check to the dealership, which serves to credit cash, and then the account that we would hit in the account line would be our fixed asset account. Now, if we have a note payable that goes along with that new asset, we would be setting that up as a long-term liability. within our chart of accounts as well. So what happens when we get rid of an asset? We sell it, we scrap it, we trade it in. Well, at that point, we're going to remove it from the books because the business no longer owns it. So we do that usually through a journal entry where we're going to reduce the asset, we're going to zero out the accumulated depreciation, and we're going to record any gain or loss if we sold the asset in some way. So when we're talking about figuring depreciation, there are three different ways to do that. We can either do it in a straight line manner, meaning that we're going to divide it up evenly like we did in our equipment example with our $3,000 asset. So we divide it up evenly over the class life of that asset. Or we can do it in a variable method. So it depends on usage, like mileage or hours. So if we use an asset more in 1 year, we're going to take a bigger depreciation, or we use it less, we take less depreciation expense. Or we do it in a way that is accelerated. So we're recovering more of the cost up front. We're taking a bigger depreciation deduction in the first year or two. So some of the common depreciation methods that you'll run across are straight line, which we mentioned was divided evenly, declining balance, which could be either double declining balance or 150% declining balance, or we're taking more at the beginning, units of activity, which you'll also hear called units of productivity, where we're taking some sort of a unit, an hour, miles, and we're using our actual usage to determine our depreciation expense, or some of the year's digits. Now, those are book accounting, right? Those are for our accounting records. What we do on the tax side of things could be a completely different method. And because there's so much complexity with that, I'll do a separate video that does the overview of depreciation for tax purposes. So the choice of depreciation method impacts both the income statement because of depreciation expense and the balance sheet because of asset value. So the higher your depreciation expense, the lower your profit. The lower your depreciation expense, the higher your profit. We're also impacting accumulated depreciation, which makes a difference in how much our assets are worth on the balance sheet. So making those depreciation decisions in a business have a definite impact. Now, one thing that we never depreciate, even though it's a fixed asset, is land. So don't depreciate land. Don't do it. And if you're an accounting student, your accounting textbook will try to trip you up with that. Okay? Never depreciate land. So in our next videos for this playlist, we will talk about the 4 different methods that I mentioned for figuring how much depreciation to take and what the best practices are for taking that depreciation. So join me for those. Until next time, stay balanced, my friends.